Hey all, today we're going to be talking about the potential mortgage collapse or the potential mortgage crisis that we could be facing. You might have noticed that a lot of lenders have been pulling their mortgage products off of the shelves and have stopped offering them out throughout the entire period of the crisis so far. And if you have a look in a little bit more detail, you'll see that a lot of lenders have stopped lending to people that only have a 10% deposit or even a 20% or a larger deposit. And that's exactly what we're going to talk about today. We're going to be talking about whether these banks are struggling financially and whether they're running out of money, and also when these mortgage products are likely to return. But guys, before we get into the video, please be sure to smash the like button down below, as this really helps out with my channel. And it'll also give you one entire week of good luck. Now let's get into the video. Now let's start with a bit of background and talk about how the current situation is affecting the mortgage market. In the US, you'll notice there's been a whole load of unemployment. And in the UK, this unemployment has been fairly muted due to the furlough measures in place. But when these measures end in June, we could be in for a giant spike of unemployment. This is obviously going to cause a lot of people to lose their jobs. And if they don't have a good savings reserve, they also might end up defaulting on their mortgage. And this way, the banks won't be making much of a profit from the interest that's generated or that they charge on those mortgages, and they might even struggle to get their money back, as they'd have to sell the property to recuperate the loan that they gave out. This could really impact the bank's profit for the current year and could put them in a risky position in terms of cash flow. Add on to this the other losses that the bank might have been taking on as well, from their investment banking teams, the lack of customer funds coming into the banks, and also the lack of external investment. And you can see that cracks could really start to show in some of these banks. Now, it's also worth noting that if a whole load of properties flood onto the market, it could really impact on property prices, because there'd be this massive surge in supply, but demand would stay the same or potentially even fall, because people wouldn't be able to afford a new house if they've just recently lost their job. This will also really impact the mortgage market, because it means that a lot of people will struggle to remortgage when their fixed rate period comes to an end, because obviously their home will potentially be in negative equity or will have lost a lot of value, and also the banks aren't lending like they used to because they've pulled a lot of their mortgage products from the shelves. This will leave people having to pay more each month as they'll be onto their variable rate mortgage, which is obviously a lot higher compared to the fixed counterpart. This will further cause people to potentially default on their mortgage and even more homes to flood into the market. But it seems that the reason why the banks are pulling these mortgage products from the shelves isn't because they're running out of money, and we'll talk about why they're not running out of money in a little bit, but it's to reduce their risk and to stop themselves from suffering further losses. The banks obviously know about the rising unemployment and the potential risk of the property market falling, and therefore they're trying to insulate themselves from suffering further losses by making the lending criteria stricter and also lending smaller amounts to people. Therefore, if the homeowner does lose their job and default on their mortgage and the property market falls, the bank can still fairly easily take the property and sell it and recuperate all of the money that they lent out. If you've enjoyed the video or found it interesting so far, be sure to subscribe to the channel, because I make new videos just like these 3 times a week. Now let's also talk about interest rates. You might know that the Bank of England in the UK and the Fed in the US cut interest rates significantly the other month. The Bank of England actually cut interest rates from 0.75% to 0.1%. Now you'd expect this interest rate cut to be passed on to your mortgage or your potential future mortgage, because it's probably likely that your savings rates have already been cut. But if you take a closer look at the mortgages that are on offer, you'll notice that these mortgages have an even higher interest rate, not a lower interest rate, than before. This is because a lot of lenders are pulling their mortgage products from the shelves, and therefore the only lenders that are left lending to people with, say, a 10% deposit are going to be those lenders that charge a much higher interest rate as a way of mitigating their risk. This is obviously making mortgages even more unattractive at the moment, as it means that you either have to have a giant deposit or use the current deposit that you do have but pay a much higher interest rate. And that seems quite unfair at the moment, as a lot of people are already struggling due to unemployment or due to being on furlough, meaning that they're receiving a lower salary than they usually would. Now, how does what's happening now differ from 2008, and why aren't the banks necessarily running out of money? And in 2008, the banks took on heavy losses for 2 main reasons. The first one is that they gave out bad loans, and the second one is that they let people bet against these loans. Back in 2008 and before, the banks were giving out what were called ninja loans, and these loans were given to pretty much anyone. And these loans were given to people that had no income, no job, and no assets. And the banks were doing this because they knew that they could just sell these mortgages onto an investor, and they were just trying to generate really big profits. because obviously they were taking a fee on setting up the mortgage and then just offloading it to someone else, and they weren't really considering the consequences.
If I write a loan on Friday afternoon, big bank is going to buy it by Monday lunch.
And in 2007, 2008, the fixed rate period on these mortgages expired and the variable rates kicked in. And then thousands and thousands, and if not hundreds of thousands of people defaulted on their mortgages because they couldn't really afford them anyway, let alone when the variable rates kicked in. And therefore, a lot of lenders still had some of these loans on their books and took on pretty significant losses. Now, the banks also sold CDSs, or credit default swaps, on groups of these loans called CDOs, or collateralized debt obligations. And this is where it gets a little bit complicated, so I'll try and make it a bit more simple. But basically, some people realised that these loans that the banks were giving out were utter crap. So they went to the banks and said to them that we bet you that these loans are going to go bad and people are going to default on them. And if they do, you have to pay us 20 times whatever we bet. And the banks turned around and said, fine, we know that these loans are absolutely perfect and there's no way people are ever going to default, so we'll happily pay you 20 times whatever you bet. And then lo and behold, obviously the loans did go bad and people did default, and therefore the bank lost a lot of money because not only had they given out these loans and not been able to get all of the money back in, but also they had to pay out for the massive bets that they made, which absolutely destroyed the banks. A few of the banks actually went under and ceased to trade, and a few others had to be bailed out by the taxpayer, which is you and I. This obviously caused the bank to have massive cash flow problems, and therefore they couldn't really give out loans to many people because obviously they just didn't have the cash for it. This combination of the massive oversupply of houses onto the market caused by people defaulting on their loans and the lack of lending given out by the banks is effectively the perfect recipe, because it caused a giant increase in supply with a forced reduction in demand, because even if people wanted to go out and buy a house, well, they couldn't because the banks didn't have enough money to give out for mortgages. And that is effectively what caused the housing market to fall. So how does that differ from today? Unfortunately, this time round, the banks haven't been giving out ninja loans. They've only actually been giving out really secure loans and really confident loans, because mortgages tend to work on affordability, and therefore a bank will only lend you about 4.5 times your salary, and they'll want to have a look at your outgoings to make sure you can easily afford the repayments. Therefore, the banks have only really been lending to people that earn a good amount of money and can save a good portion of their paycheck, because obviously they have to be able to afford the mortgage and have a good amount left over. And therefore, even though there's quite a high risk of unemployment at the moment, the banks feel that a good portion of their customers could continue paying their mortgage for a few months, even if they do lose their job, because hopefully they've got a good amount of savings to be able to afford it. Also, the banks haven't been accepting nearly as many bets against loans as they did in 2006 to 2008. It's believed that some banks did start accepting bets against loans, or at least selling groups of loans, dubbed BTOs, or bespoke tranche opportunities, but it wasn't nearly at the same rate as it was before. And because of this, it's unlikely that the banks are going to struggle as much as they did before, and they're probably not going to run out of money during the crisis, and they're probably also not going to need to be bailed out by the government. And this means that we're not going to see a reduction in demand of people wanting to buy the houses, because the banks are still going to be lending out money. And it's likely that they've only taken their mortgage products off the shelves to reduce their risk. Now, on top of this, the banks are also giving out holiday periods, or mortgage forbearance, which will help people that have lost a job or are likely to lose their job after the furlough measures at least a few months to be able to find a new job before they default on their mortgage. Therefore, hopefully, we won't see such an oversupply of homes onto the market. And I spoke more about the supply and demand equation and how that affects house prices in my housing market crash video. And guys, make sure that you comment down below what you think is going to happen to the mortgage market. Are banks going to struggle? And when do you think these mortgage products will be returned to the shelves? Now let's talk about when I think these mortgage products are going to be bought back. And I've said earlier in the video that I think that the banks have removed these mortgage products from the shelves to reduce their risk, and therefore they'll put them back onto the market when their risk is lower. And I suspect that this will be when the crisis is over, and probably a few months after that. That way the bank have had some time to assess the damage that's been done and to make sure that there's not going to be another wave of unemployment or business failure. And that'll obviously help the bank not take on more losses. The tough part though is that no one really knows when the crisis is going to be over, and no one really knows how much damage is going to be done to businesses and just how bad the unemployment's going to get. So obviously we also don't really know how long it's going to take to recover and how long it's going to take the banks to put those products back on the shelves. And that's obviously a bit of a problem because people are going out into the market right now to try and refinance their mortgage. Maybe they want to refinance before the housing market falls, so they're locked into a fixed deal for quite a while. Or maybe their fixed rate is literally just about to expire and they need to try and remortgage as quick as possible. Or maybe they're trying to go out and buy their first house before they potentially get a pay cut or lose their job, just so that they can get onto the housing ladder. But as those mortgage products aren't on the shelves, or well, the better mortgage deals aren't on the shelves, and it's unknown how long it's going to take for those mortgage products to go back onto the shelves, it's leaving a lot of people confused about what to do. And I suppose ultimately it comes down to your appetite for risk and your current position in life. Now, I just want to remind you that obviously I'm not a financial advisor or anything like that. I'm just a guy that makes videos on YouTube. But I think if you don't have many responsibilities, it might be worth just taking the risk and remortgaging or buying a house now. But obviously if you do have a family and you are risk averse, it might just be best to stay as you are and try and stockpile cash so that you obviously have enough money to pay for any expenses as they come up. And as always, if you want to learn more about property investing, then be sure to watch some of my other videos. Alternatively, subscribe to the channel and ding the notification bell. That way, you'll be alerted when I upload a new video. Cheers.